What is a ratio put spread? Have you ever wondered how traders can profit from a stock's decline while managing their risk? One strategy they often use is called the ratio put spread. So, what exactly is a ratio put spread? This options trading strategy involves buying a certain number of put options at one strike price and selling a larger number of put options at a lower strike price, all with the same expiration date. The most common setup is buying one into money or at the money put option and selling two out of the money put options. This creates a 1-to-2 ratio. Traders typically initiate this strategy for a net credit or sometimes a small debit. The goal is to profit if the underlying stock price declines moderately to near the short put strike price by expiration. Maximum profit occurs when the stock closes exactly at the short strike price. At that point, the short puts expire worthless while the long put retains its intrinsic value. The ratio put spread has a bearish to neutral bias. It benefits most when the stock price stays within a specific range between the long and short put strike prices. If the stock price rises above the long put strike, all options expire worthless, allowing the trader to keep the initial credit as profit. However, there is a significant risk to consider. If the stock price falls significantly below the short strike price, the trader faces unlimited risk. This is because they are short more puts than they are long, exposing them to potentially large losses if the stock drops sharply. Key features of a ratio put spread include its structure, where a trader buys fewer puts at a higher strike and sells more puts at a lower strike. All options share the same expiration date. The profit profile indicates maximum profit when the stock price is near the short strike at expiration, while profit is limited if the stock rises above the long put strike. The market outlook for this strategy is slightly bearish or neutral, expecting limited downward movement. Traders often establish this position for a credit, which helps offset the cost of the long put and can provide initial income. In practical terms, traders use ratio put spreads when they expect the underlying stock to decline moderately or remains stable near a certain price level. This strategy can generate income through the net credit received while profiting from a moderate drop in the stock price. It is essential for traders to monitor the position closely, as sharp declines can lead to significant losses. Adjustments or risk management techniques may be necessary if the stock price moves beyond the short strike range. So, the next time you hear about a ratio put spread, remember it is a multi-leg options strategy that combines long and short puts in a ratio to capitalize on a moderate bearish or neutral outlook. It has limited profit potential but carries significant downside risk if the stock price falls sharply.